Hey, what's up everybody? Welcome back to Selling Vega. In today's video, we're going to continue our options trading series and talk about one of my favorite income-based option strategies, covered calls. What it is, we'll walk through an example together, as well as what I like to look for before I put on a covered call strategy. If that all sounds good, please hit that like and subscribe button, as well as the alert button so you know firsthand when my next videos drop. Now, without further ado, let's get started. A covered call is where you sell a call option on a stock in which you already own 100 plus shares of. When you sell a call, remember you are receiving premium. So a covered call strategy is used by investors to generate an income stream on the stocks that they already own. To do this, you first have to buy 100 shares of a stock. So let's use a stock that I've been seeing as a popular covered call play on some option blogs and groups that I follow, and that is SoFi Technologies. SoFi is a financial banking firm that operates in lending, financial services, and now fintech with its recent acquisition of the Galileo platform. The long-term bull case here would be SoFi's ability to reach a younger consumer base, its fintech and all online service, bringing lean operational costs and a possible sustainable high margin rate, and a upcoming decision on SoFi receiving bank charter approval as a potential near-term positive catalyst. The bear case here would be SoFi's rich $12 billion market cap valuation may already be pricing in this early period of high growth, high margins, and ultimately the lending financial services business is a lower margin business. So is SoFi's current price overvaluing that business or the business prospects going forward, especially with the risk of bigger banks adopting some of those methods that have made SoFi successful? Opinions aside, I'm just going to use SoFi here to highlight the income potential of the covered call strategy. So let's say you bought 300 shares of SoFi at the current price, which is right around $15 a share, as you can see on the right side of the screen. So about a $4,500 initial investment. Now, owning these shares gives us the ability to sell calls using those shares as the collateral. So let's say we want to sell the October 1750 striked call that is currently selling for 38 cents a contract. I had it at 39 cents just a moment ago. This gives us the obligation to sell those 300 shares at 1750. Selling those three contracts gets us $114 in premium after transaction costs. Most brokers charge $1 per contract as a transaction fee, so just knock a penny off your sale price or the option price to know how much you'd receive after fees whenever you're selling an option. That's a good rule of thumb. So what are the outcomes here? Well, if SoFi is below 1750, then you would keep the premium, the option would expire. So the $114 you received up front, you would keep the entire amount. If SoFi is above 1750, then you are obligated to sell the shares at 1750, no matter where the shares are at, which you would sell for $5,250. This makes your max gain $795 or 17.67%, or roughly 17.67 for the 1 month holding period on SoFi. And again, that max gain number is your shares, the gain on your shares, plus the premium that you received by selling the option contract. The point at which your opportunity cost kicks in would be your call's break-even price, which is the strike price plus the premium. So if the price is above $17.89 at expiration, then you were better off just buying and holding the shares rather than selling the call. But the 1 month yield on this strategy would be your $114 premium number divided by your initial investment, which is roughly 2.53% in yield for the 1 month period. So if you're willing to cap your upside for a 1 month holding period or however long you're selling your covered call for, then you can start to create an income stream or a monthly yield on the assets that you're holding. And if you repeat this 11 or 12 times a year, you can get an almost 30% yield on SoFi specifically by doing this strategy. So what are the risks to this? Well, the risks are that SoFi's stock trades down and you aren't able to sell calls at strike prices above your cost basis on the shares, at which point you can decide to either wait and hold the shares without selling calls. You could sell calls below your cost basis to keep the income going, but risk selling your shares at a loss. For example, pulling up the chart here, if you had started this SoFi strategy or the covered call strategy around here, you might own SoFi shares above $20. You may have earned $1 or $2 in option income so far, but now what do? Do you sell the $17.50 and risk taking a loss? We'll talk more about how to manage a covered call strategy when things go wrong in more detail in a video coming soon. Another risk is that SoFi, a stock in which you liked, has risen dramatically above $17.50, and now you've missed out on a huge gain. You can account for this or manage this by adjusting your strategy around known periods of volatility, such as earnings or big announcements. For example, if I knew that SoFi's bank charter decision was coming out in November, or December, for example, I may adjust the strike prices to a higher strike price in order to give myself even more upside. That way, if SoFi does move or really takes off, I can capture more of that move. To help me decide which stocks might be good candidates for covered calls, I like to use a checklist. First, and this kind of goes without saying, I want to be bullish on the stock and the company's prospects in the long term. This will help me narrow it down to companies that I'm willing to own shares of and hold them. Second, I want to find stocks whose prices make them affordable for me to own 100 plus shares of the company within my portfolio, without it being a large outsized position. Ultimately, most covered call investors will own many positions and run covered calls on some or all of them at once, providing the income within a diversified risk profile. This one is more on the option side. I like to pick strike prices where I'd feel comfortable selling at over the time period I choose. I love this strategy for its income potential, and I want to make sure it's not psychologically taxing by selling shares or setting myself up to potentially sell shares at prices I'd be upset selling it for. I like to find yields that are greater than 1% per month. That, in my mind, makes it worth capping my upside on companies I like in order to earn the income stream. And that 1% per month is an average. I don't run monthly options on every covered call strategy I do. Some are quarterly, semi-annually, even annually. It depends on the stock you decide to run the covered call strategy on. So you might not be comfortable capping your upside at certain strike prices that will net you a legitimate income in the time period. Now, as we see SoFi still on the page here, the yield might be high on a volatile small cap stock like SoFi, but you'll find smaller yields on some of the less volatile large cap names. Like if we pull up some of these other option chains here, you'll see that on Apple, for example, the 1 month yield, you got to go pretty close to the current Apple price in order to earn decent yield according to that 1% monthly average rule. So if you're not comfortable selling at strike prices for that 1 month period, you can simply just increase your expiration, maybe go out to December and sell something that's more quarterly, something where you can earn a yield and have it be at a strike price where you will feel more comfortable or are more willing to sell the shares. I use the 1% monthly average mark because there are covered call ETFs out there that can earn 8 to 10% yield a year. So I'm using that as a benchmark on whether it's worth it to me to cap my upside on a single stock position I'm bullish on, just for the income. I'll be covering these covered call ETFs in a future video. The last thing on the checklist is make sure you like where it is on a chart before you sell your call. I'm always confirming with the chart and my indicators that it's a decent time to sell your call, and I like to use natural support and resistance levels on the chart itself to gauge where I might like to sell a strike price. Because of this rule, I'm not doing 12 calls per year on stocks I'm doing monthly covered calls on. I'm usually tracking on average around 10 call sells per year on my monthly plays, and this is because I will sometimes skip months because I like a certain setup, or I think that, for example, SoFi, if you like SoFi bouncing off of this kind of natural support level going back out to some recent volatility there, are you willing to cap your upside and sell your call here if you think SoFi might bounce? If you are bearish on SoFi, or you still want to hold but you're worried about where it is in the near term, you think it might break through these support levels, then yeah, you might be more inclined to sell that 1750 strike call. So again, just re-emphasizing, I always am looking at the chart and the indicators before I'm selling calls. I'm not just blindly selling calls for the income stream. The covered call strategy is a great tool used by investors to boost their returns on stocks they are owning. By doing this strategy on a portfolio of diversified holdings, you can consistently add an income stream to your portfolio on a weekly, monthly, quarterly, annual basis. You can create an income stream on small cap stocks that currently don't pay dividends, or add yield to a stock that's already paying a dividend to boost that yield even further. This can help create a buffer zone in performance relative to the S&P 500 if you're benchmarking to that, or create an income stream you can use in everyday life. We'll be covering more option income strategies in future videos. Thanks again for watching. Please don't forget to like and subscribe to my page, as it really does help me continuing to help you guys. Happy trading. Let's make some money.